If you don't know where to begin, better ask when.
Shane, good to see you. Let's talk through 3 RMD strategies to reduce your tax burden in retirement. And let's just start with the basics. What are RMDs and how are they calculated?
Well, RMDs stands for Required Minimum Distributions, and this is a forced withdrawal system implemented by the IRS against your qualified or pre-tax retirement accounts, IRAs, 401ks, that type of money. So think about it like this. Let's say you were retired at 65, and at that point you had complete discretion over your retirement accounts. But once you reach the age of 73 or 75, this forced withdrawal system, these RMDs take effect, and all of a sudden you have a forced withdrawal, which becomes a forced income in retirement, which then gets applied to your income tax brackets. But as far as the calculation is concerned, it's derived from your income or from your account balance and your age. And the IRS runs a calculation based on life expectancy to determine how much you have to take out in the form of RMDs each year at a certain age.
And I know you make certain that your clients take those RMDs when they need to, because if you miss it, there is a stiff penalty.
There's absolutely a stiff penalty. Of course, we're dealing with the IRS here, so they don't give anyone any breaks, but it's 25% penalty if you miss the RMD, plus the entire amount you were supposed to take, and of course, then all the taxes on top of that. So pretty severe penalty. You want to make sure you don't miss that because there's no specific reminder. And it's easy to forget, especially when you're 73 or you're 75, and it does get forgotten about quite a bit. So having someone help you figure that out and remind you is never a bad thing.
Right. All right. So now let's talk through those strategies. And the first would be to start taking distributions from those accounts as soon as you're able, as opposed to waiting until they're required, which you can do starting at age 59 and a half.
Yes. And so the idea here is to try to start to use those accounts rather than save them for the very last second. Therefore, your RMDs will not be as big. If there's less money in these pre-tax buckets, by the time you reach RMD age, the RMDs themselves won't be so severe. That's the thought.
Mm-hmm. And then the second strategy, one that you and I have talked about many times, Shane, Roth conversions.
Well, Roths have so many great advantages. When you get your money into a tax-free world or a tax-free bucket, there's so many advantages. The biggest one in this conversation being no RMDs. There are no RMDs on Roth accounts because really the whole point of an RMD is to get you to pay the tax on those dollars that haven't been taxed. And if the money's in a Roth, it has been taxed, therefore they're okay with you letting it sit there. One other big thing to consider when your money's in a tax-free world, there's no RMDs, which means there's no effect on your income tax later in retirement because of the RMDs. RMDs would also affect your capital gains rate, Social Security tax, what you potentially pay for Medicare. All of these things are affected by your RMDs. And if you get your money into a tax-free world, into a Roth, then none of those things are affected. Your income tax is not affected. Medicare is not affected. Social Security tax is not affected. And it really helps to ease the tax liability in retirement.
Yeah, so many benefits. And then the last strategy that we wanted to talk through, I like this one because it's kind of a win-win for everyone, a qualified charitable distribution.
These are great. If you're someone that is charitably inclined and you're already giving money to charity or wherever you see best use your money, there's actually an even better way to do it potentially, and that's using qualified charitable distributions, which allow you to take money from a qualified account, from an IRA, for example, give it to the charity. You might even be able to deduct it again, not pay any taxes, of course, when you take it out. That's the big thing with a QCD. You don't pay taxes when it comes out. And then the charity receives that money tax-free as well. So it's a great way to get money out of an IRA tax-free and give it to a charity, especially if you're already doing these things, an even better way to do it.
Right. I always say that one is specifically for people who are putting the money in the collection plate. There's a better way to do it. Glad we got to talk through. And again, just to kind of bring this home for everyone, this all comes back to strategic tax planning. A lot of people assume they're going to be in a lower tax bracket when they retire, but that's not often the case.
Well, that's not often the case. Like I said, people don't realize that your RMDs are going to cause increased tax on your Social Security, your capital gains rates, your income tax, and even potentially your Medicare. And so therefore, people in retirement find they pay more tax than they were ever expecting to. And it's really quite a scary thing. But the IRS does not give you any guidance or any tips on how to affect your own taxation and try to minimize what you pay while still staying within legal guidelines. And therefore, you have to take it into your own hands, and an advisor can help you set forward a plan to make sure you pay the least amount in taxes that's actually necessary.
Yeah, crucial. And it all comes back to proactive planning, getting these strategies in place now to pay less in retirement. So Shane, if somebody would like to talk this through with you, what's the best way to reach you?
The best way to reach us is here at the office. You can call our phone directly here, 602-456-1928, or visit our website, winstonandcompanies.com. You can schedule or request a visit right on there.
Great. Shane, thank you.
Thank you, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask when.